Section 2. The Loan Estimate. Where the numbers begin. Let's go back to the beginning. In Section 1, Emily called Sarah because she had questions about her closing disclosure just days before the anticipated closing. Now we're going to rewind the transaction. Several weeks earlier, Emily and Carlos had just signed their purchase contract on the Gilbert home. They were excited, nervous, and suddenly surrounded by emails. Escrow wanted information. Sarah was sending reminders about inspections. The lender wanted documents. Then Carlos received another email and called Sarah. Sarah, Jason from the mortgage company sent us something called a loan estimate. Is this our final loan? That's a great question, and it's exactly where many consumers misunderstand the mortgage process. Meet the loan estimate. The loan estimate, commonly called the LE, is one of the central disclosures created under the TRID framework. Its purpose is to provide consumers with important information about the proposed mortgage transaction in a standardized format, so they can better understand the loan and compare financing options. Think about buying almost anything expensive. You want to know what you're getting and what it's expected to cost before you're committed. A mortgage is considerably more complicated than most purchases. There may be an interest rate, monthly principal and interest, mortgage insurance, estimated taxes and insurance, loan costs, lender credits, prepaid items, escrow amounts, and cash needed for closing. The loan estimate organizes important information so the consumer has an opportunity to review the proposed transaction. But notice the name. It is a loan estimate. That word matters. When does the loan estimate process begin? Under Regulation Z, the loan estimate timing requirement is connected to the creditor's receipt of an application. For TRID purposes, an application is generally triggered when the consumer submits 6 specific pieces of information. Those are the consumer's name, income, social security number to obtain a credit report, property address, estimated property value, and mortgage loan amount sought. Once the creditor has those 6 pieces of information, we have an important regulatory moment. Generally, the creditor must deliver or place the loan estimate in the mail no later than the 3rd business day after receiving the consumer's application, subject to the applicable Regulation Z requirements. Let's bring that back to Emily and Carlos. Jason already has their names. He has their income. He has the information necessary to obtain their credit report. Now that Emily and Carlos have identified the Gilbert property, he has the property address and estimated value, along with the loan amount they're seeking. The process has moved beyond, we're thinking about buying someday. Now we're dealing with an actual mortgage application for an actual property. Why should Sarah know the 6 pieces? Sarah isn't responsible for determining the lender's compliance deadline, but understanding what triggers the process helps her understand what's happening to her client. Here's where agents sometimes create confusion. A buyer says, I talked to the lender 3 weeks ago, so why am I just receiving this? The agent immediately assumes something went wrong. Not necessarily. Talking with a lender isn't automatically the same thing as providing all 6 pieces of information that constitute an application under the TRID rule. This is why we don't jump to conclusions. Sarah can say, let's ask Jason when your application became complete for purposes of the disclosure and have him explain the timing. That's helpful. Sarah declaring, your lender violated federal law is something very different. Can the buyer shop around? One important consumer benefit of the loan estimate is the ability to review the proposed loan information and compare it with other financing options. Imagine Emily receives one loan estimate showing one set of loan terms and costs, while another lender offers something different. Which loan is better? Be careful. Sarah should not simply look at one number and announce which mortgage Emily should choose. A loan with a lower interest rate may involve different upfront costs. Another loan might have different mortgage insurance or other features. This is where the buyer needs to ask detailed questions of the mortgage professionals offering the loans. Sarah can encourage comparison. She shouldn't become the loan officer. So these are my final costs. Carlos looks at the loan estimate and says, great, so this is exactly what we're paying at closing. Some charges have limitations on how much they can change. Other amounts may change under circumstances permitted by the federal rules. Certain events can also permit revised estimates. We're going to examine those rules later, because this is one of the most misunderstood parts of TRID. For now, Sarah should make sure Carlos understands the basic distinction. The loan estimate provides important estimated information about the proposed mortgage transaction. The final transaction figures come later. Don't wait until closing week. Here's a broker habit worth developing. Teach buyers to open mortgage disclosures when they receive them. Don't let Emily ignore a loan estimate for 2 weeks because the lender handles all that. If something doesn't look right, the best time to ask questions is early. Is the loan type what Emily expected? Does the interest rate information match her discussions with the lender? Does she understand the estimated monthly payment? Are there costs she wasn't expecting? Questions don't necessarily mean something is wrong. Questions mean the consumer is actually reviewing the disclosure. That's exactly what these disclosures are intended to encourage. Broker tip: understand the process without becoming the lender. When Emily asks Sarah a financing question, Sarah should think, is this a transaction coordination question or a lending advice question? Sarah can monitor deadlines, communicate with Jason, help Emily identify questions, and watch for issues that could affect the purchase contract. Jason should explain the mortgage terms, calculations, lending requirements, and the lender's compliance obligations. That boundary protects Emily. It also protects Sarah. Emily and Carlos now have their loan estimate. But there's another question we haven't answered. Can the lender charge the money before they receive it? And can the lender require Emily and Carlos to commit to the loan immediately? Those questions take us into the next part of TRID. Online discussion 1. Carlos tells Sarah that he spoke with a lender 2 weeks ago, but only received his loan estimate after identifying the Gilbert property. Does that automatically mean the lender provided the disclosure late? Answer: no. Simply speaking with a lender does not necessarily mean the lender received an application for purposes of the TRID loan estimate requirements. Regulation Z identifies 6 pieces of information associated with an application: the consumer's name, income, social security number to obtain a credit report, property address, estimated property value, and mortgage loan amount sought. Sarah should avoid declaring that the lender violated the law, and instead encourage Carlos to ask the lender when the application was considered received and how the disclosure timing applied. Why should Sarah encourage Emily and Carlos to review their loan estimate immediately instead of waiting until closing? Answer: early review gives the buyers an opportunity to identify questions about the proposed loan terms, estimated payment, closing costs, or other information while there is still time to obtain clarification. It can also help identify misunderstandings before they become closing week problems. Sarah should encourage the review while referring detailed financing questions to the lender. 3. Emily receives loan estimates from 2 lenders and asks Sarah which loan she should choose. What is the appropriate role for Sarah? Answer: Sarah can encourage Emily to carefully compare the disclosures and ask each lender questions about loan terms and costs. But Sarah should avoid presenting herself as the mortgage professional responsible for determining which financing product is best for the buyer. Sarah's role is to protect the client's interests within the real estate transaction while directing specialized lending questions to qualified mortgage professionals.